This block represents the $7.5 trillion that changes hands every single day in the foreign exchange market. When you compare that volume to the global stock market or the entire crypto ecosystem, you see exactly where the world's actual liquidity lives. You can access this market from your living room with a laptop and internet connection. But before you place a single trade, you have to accept a stark reality. 70 to 80% of retail traders lose their money here. The remaining 20 to 30% are consistently profitable. They do not have higher IQs. They do not have insider connections. They do not rely on luck. They survive because they have built a rigid framework of education, discipline, and repeatable process. Currency trading is a zero-sum professional arena. When a disciplined trader profits, an uneducated participant has simply transferred their wealth to them. Look at this transaction flow. If you have ever traveled internationally, you have already traded Forex. By simply converting your US dollars for euros at the airport, you have executed a trade on the euro-US dollar pair. When you return home and exchange those euros back into dollars at a higher rate, you keep the difference as profit. In digital trading, we measure these tiny exchange rate shifts in pips, usually the fourth decimal place in a currency pair. Depending on the size of your position, each single pip of movement dictates your exact dollar profit or your exact dollar loss. This scale illustrates how you dictate that position size through leverage. Leverage allows a small deposit to control a massive amount of currency. If you use a 50-to-1 leverage ratio, a $1,000 deposit controls a $50,000 position. If the market moves 1% in your favor, you make a 50% return. If it drops 1%, 50% of your account is gone. Market mechanics are completely neutral. The exact same tools required to build wealth are the exact same tools that will destroy an inexperienced trader's account. On this stripped-down price chart, we are using technical analysis to isolate specific buying and selling zones. Price repeatedly bounces upward from this flat lower boundary, known as support, and is pushed downward by this upper boundary, known as resistance. This creates strategy 1. Identify the daily support level. Wait for price to drop back to that exact line and form a bullish candlestick pattern. Enter the trade. Most importantly, strictly place your stop loss just below that support boundary and target the resistance level above for profit. Strategy 2 adds moving averages. We use the 50 and 200 exponential moving averages to confirm an established uptrend. Instead of guessing, we simply wait until the price pulls back and touches the 50 EMA line before entering a buy order. Massive institutional algorithms are watching these exact same levels. When you trade support and moving average bounces, you are identifying where institutional money is stepping into the market, and you are simply riding their wake. Here is a new, clean chart showing a clear uptrend, with the price resting precisely on the 50 EMA. Pause the video right now. Based on the rules we just covered, tell me exactly where you would place your entry, your stop loss, and your take profit. Your entry occurs exactly at the bounce. Your red stop loss line sits strictly below the moving average. Your green take profit target sits at the previous high. Strategy 3 targets momentum. In breakout trading, you find a market trapped in a tight consolidation range. You wait, you enter only when the price violently breaks the upper boundary with heavy volume. Strategy 4 narrows that focus. By isolating your breakout trading specifically to the pre-market window between 1 a.m. and 3 a.m. Eastern Standard Time, you position yourself to capture the massive volume injection of the London session open. Technical setups do not magically predict the future. They are simply structural frameworks designed to capture market energy as it releases from one phase to the next. Everything we have covered is secondary to the 1% rule. You must never risk more than 1% of your account balance on any single trade. This dual bar chart proves why. If you hit a 20-trade losing streak at 1% risk, you still retain 80% of your capital to trade tomorrow. If you risk 10% per trade, your entire account zeroes out completely after just 10 losses. By combining that low risk with a 1-to-2 risk-to-reward ratio, meaning you risk $10 to make 20, you can be wrong on 50% of your trades and still generate consistent profit over time. Flawless technical analysis has zero value without the risk parameters to survive a losing streak. Finding good entries is a hobby. Strict capital protection is the job of a professional trader. To enforce parameters, placing a physical stop-loss order in your trading platform is completely non-negotiable. It is the automated circuit breaker that protects you when your internet drops, or a sudden news event sends the market 200 pips against your position. Traders do not manually delete their stop losses or break the 1% rule because they fail to understand the math. They break the rules because they allow the fear of being wrong and the greed for larger positions to override their execution plane. You now know how to read the mechanics of a currency pair, how to locate high probability entries, and the strict mathematical rules required to protect your capital. But knowing the rules and executing them daily are two different things. In the next video, I will give you the exact 90-day execution roadmap to put this framework into actual practice.